morning, Chairman Hill, Ranking Member Waters, and the members of the committee. Thank you for holding this important hearing and for the invitation to Better Markets to testify. Well, the focus today is the Dodd-Frank Wall Street Reform Law. That law cannot be properly discussed or understood without reviewing the devastating financial crash that started in 2008 that made the law so necessary. That was the worst financial crash since the Great Crash of 1929, and it caused the worst economy since the Great Depression of the 1930s, which is why it was called the Great Recession. The damage caused by that crash ruined the lives of tens of millions of Americans, crushed small businesses and community banks, grievously damaged our economy and financial system, ballooned the country's debt, and undermined the pillars of our democracy, which depends upon an economy delivering rising living standards and broad-based prosperity. Just a few facts to illustrate the horrific scope of the damage caused to Americans from that crash. 13 months after the September 15th bankruptcy of Lehman Brothers, the U6 unemployment rate reached 17.2%, throwing more than 27 million Americans out of work. 16 million foreclosure filings happened during the Great Recession, causing millions of families to lose their homes. 40+% of homes in the United States were underwater, meaning their mortgages were higher than the value of their homes for years after the Lehman bankruptcy. 10 years passed before the unemployment rate in the United States returned to pre-2008 crash levels. And after 8 years after the Lehman bankruptcy, 90% of the American people were poorer at the end of 2016 than they were in 2007 by 17 to 34%. It's also critical to remember that the 2008 crash was an avoidable man-made financial crash and disaster that didn't have to happen. It only happened because too many elected officials, policymakers, regulators, and others who should have known better listened to the financial industry's siren song of deregulation, which, as in the Greek myth, inevitably resulted in a catastrophic crash. That deregulation and crash resulted from too many believing the financial industry's claims that its interests overlap with the public interest and that the industry is primarily focused on economic growth, job growth, credit supply, helping community banks, small businesses, and disadvantaged groups. The industry continues to trumpet these issues. Indeed, it's the chorus for the siren song of deregulation. Those claims, however, are usually smokescreens behind which they hide their profit and bonus maximizing motives. That's fine for the private sector, and that's fine for private companies, but that's not the public interest. The overriding lesson that should be learned and guide the road ahead is to reject that misleading but appealing deregulation song that the industry is singing again. It will lead to an even more horrific result, in part because the country simply does not have the fiscal or monetary capacity to properly respond to another financial and economic crash. The truth is that the threat from too big to fail, too big to manage, too big to jail, and too big to regulate financial institutions remains alive, well, and getting much worse due to the deregulation juggernaut unleashed by the Trump administration. That was proved by the failure and bailouts of the three much smaller banks in 2023, which resulted from the deregulation in the first Trump administration and cost the country more than $40 billion in direct bailouts and more than $300 billion in all-in cost. Yet the largest of those banks only had a little more than $200 billion in assets. In contrast, JP Morgan Chase alone has $3.64 trillion in assets, and the 15 largest banks in the United States have a combined $14 trillion in assets. There is no chance these much larger, much bigger, too big to fail financial institutions can be resolved without destabilizing contagion and gigantic bailouts. Now, because everybody knows that, even if many won't admit it, regulators have tried to varying degrees over the years to increase the resilience of these financial institutions in the event of the inevitable stressful situations that will threaten their viability. Engaging in massive deregulation that significantly reduces the resilience of these gigantic financial institutions, knowing that they cannot be resolved, virtually guarantees the next crash will be much worse than the 2008 crash and could well cause a second Great Depression. That's the bad news. The good news is it's not inevitable. It can be prevented. Indeed, we know how to prevent it because we did it for more than 70 years. From the major laws and regulations imposed on the financial industry during the Great Depression of the 30s until about September of 2008, the U.S. did not suffer from a major financial crash. Importantly, and finally, at the same time during those decades, when the financial industry was under the most robust regulation in the history of the world, the U.S. economy grew at historic rates and generated broad-based wealth creation. That proves that a strong regulated financial industry is not only compatible with, but necessary to achieve above-trend growth, stability, and broad-based wealth creation. Thank you.